Hello, welcome to the next episode of the Just Peachy Show. I'm your host, Peachie Thompson. As you know, Just Peachy Show is a show where we interview leaders and subject matter experts in the fields of insurance, finance, and taxes. Today, I am so excited because I get to speak to someone, and you get to hear him to someone who's been in the investment industry for over 20 years. He is the founding partner of East Bay Investment Solutions. Please help me in welcoming Mario Nardone, CFA. Mario, welcome, and thank you so much for joining us today.
Thanks, Peachy. Good to see you and happy to do it.
Yes, thank you for agreeing to be on the show. I know you're very busy. And, I always start this show by asking my guests to tell us a little bit about yourself, please, so our listeners and viewers know who you are and a little bit about your background.
All right, sure. Thanks, Peachy. As you said, I started my career over 20 years ago at Vanguard Mutual Funds, which many people know, one of the largest and most respected institutions in the industry, up in Philadelphia. But then after 10 years, I migrated south to Charleston, South Carolina, where I was chief investment officer for a registered investment advisory practice here. And then on to East Bay Investment Solutions, which is focused on helping RIAs, registered investment advisors, and other types of advisors with their investment programs. So our East Bay's clients are all advisors, and our job is to help them get investments right and help support them in helping achieve their clients' goals.
And that's why I think this is really a treat for those consumers listening to us, because we get to hear it from you. We also have a lot of advisors listening to us as well, so they get to hear it from you as well. So without further ado, tell us what we're going to be talking about today, Mario.
All right, Peachy. Well, what we do here is on a quarterly basis, we're not market prognosticators. Our investment philosophy is not based on prediction or anything like that. But we need to pay attention to what's going on in the global economy, as well as the various investment markets, to make sure that we're positioned appropriately and so that we can communicate effectively what's going on in the markets and help it make sense for the investing public. So we take all of that information that's bombarding us all the time about inflation, recession, investments, and all that stuff, and boil it down into what really matters and what advisors and their investors can actually control.
Awesome. So I'm going to let you lead this conversation because I know you also have some slides you want to show to those who's viewing this. If you are listening to us, we're going to try to make sure that there's a little bit of a description there as Mario talks about what we're doing here.
All right. Well, here we go. So one of the things we always try to do on these conversations is to make sure we take a balanced approach when we think about what's going on in the economy and the markets. There are a lot of opinions out there, and people come to these conversations with either a pessimistic attitude or maybe an overly optimistic attitude. So we try to make sure that we see both sides of the coin. So we start the call with some bullet points that we'll go into detail on about some of the reasons that we should be optimistic and some of the reasons for uncertainty. So on the left side of the screen, and those of you just listening, I will do my best to not to describe what you're not looking at. We have seen inflation come down a little bit, and that's good. We do currently have data to support the notion that we are not in a recession today. Some people question that, but the data does not support that we're in a tough spot today. And then some might look at this as a negative, but from an investment standpoint, we've seen the US dollar come off its high points, and that's good for those of us with diversified portfolios that own non-dollar denominated assets like international stocks. On the reasons for uncertainty, I mentioned inflation is coming down, but it's still high across the globe. And we're starting to see signals that maybe a recession is in our future. And then we can't ignore the banking crisis that we saw in the month of March when we talk about what's happened throughout the quarter. And we've affectionately called what's happened in the banking sector March Madness. Peachy, before we spoke, I know you're an athlete, so maybe some of your viewers also paid attention to the NCAA tournaments. But in the financial business, March Madness had all to do with the bank sector. As a reminder, we saw a couple bank failures, Silicon Valley Bank, Signature Bank, and the Fed stepped in pretty quickly to assuage the crisis in confidence that a lot of banking customers really had over that situation. And they basically said, you know what, your deposits are safe. They even went so far as to say, beyond your FDIC limits, we're not going to let your money evaporate. And that was really what we needed to hear, right? Now, at this point, I would say, make sure you pay attention to where your cash is parked. I wouldn't go beyond FDIC limits with those banks, but also there's a lot of other opportunities for earning a decent rate of return now on cash, which is something we weren't used to before last year. So one of the things, though, that continues to be seen is what's the fallout for the banks themselves. And what we're reading about now is that profit margins are suffering. Bank stocks prices have definitely come down, and that's impacted certain types of investment strategies more than others. But in terms of solvency, it seems like the Fed is going to make sure that investors are protected. And there's probably going to be some refinement over regulations of the banks to make sure we don't see this happen again. In terms of the Fed, and it is pertinent to the banking situation, the Fed is trying to orchestrate what's called a soft landing. A soft landing is when the Fed has interest rate policy to increase interest rates to try to stem demand to bring inflation down. Now, the problem is when they do that, that has a tendency to have negative impacts on economic growth, labor, and that sort of thing. So the Fed is walking a delicate line between raising interest rates too much in an effort to stop inflation to the point where it might be past the tipping point and actually have negative consequences. And in regard to the banking crisis, the rapidly rising short end of the yield curve, short-term interest rates, put banks in a little bit of a bind because of what they're invested in, what they do with your money after you deposit it and walk out the door. So the impact that had, and if you could see the screen, what you're looking at is the market's perception of what the Fed's top interest rate is going to be when they conclude this tightening cycle. And on March 8th, the market was suspecting or expecting that the federal funds rate would get as high as about 5.7%. But only a week later, after the banking crisis, those same market participants expected the Fed to stop raising rates at about 4.6. And the reason for that is that the Fed has to balance now, once again, another potential problem if they keep raising rates that could occur in the banking system. So it's a real dilemma. And the Fed has to decide what's more important, continuing to fight inflation or make sure the banks don't get into trouble. In terms of inflation, which is what the Fed is looking at, we've seen over the last 3 years, so pre-COVID, we had inflation that was pretty benign for a number of years, if not decades. We saw inflation in the 2 to 3% range, and that's right in target and in line with what the Fed wants inflation to be. Most of that inflation came from the services sector, meaning goods basically were flat. We saw improvements in globalization and manufacturing and things like that kept goods prices reasonably in check. But when COVID hit, we started to see inflation in goods and services. Goods were tied to microchip shortages and supply chain problems and that sort of thing. But as we move towards today, and if you're looking at the graph towards the right side of the page, you see that the green portion of the inflation calculation representing goods has started to come down and is actually now back to pre-pandemic levels. But the services inflation, the blue bars, are still very high, with inflation still in the 5 to 6% range in total. Some of that has to do with housing costs, which we know kind of works on a lag, and we do expect housing costs to come down, but that's a major contributor of why we're seeing inflation remaining sticky today. I'll stop there. Do you have any questions? Is this hitting the mark, or is there anything that's popping into your mind to elaborate on, Peachie?
So I just want to repeat a few items because you did hit a lot of items in a short amount of time, Mario. So the banking turmoil that has been worrying a lot of people, in your opinion, are we headed into another 2008 financial crisis?
Well, the situations were very different. In the financial crisis, we had, think about the housing sector and securitized loans that nobody really knew what they were buying, but everything turned out to be very intertwined.
Mhm.
But this time around, it was a somewhat isolated incident, right, with a handful of banks and how they were handling their balance sheets. And I will say that the Fed stepped in really quickly to circumvent or serve as a circuit breaker to massive problems. Now, like I said, do we know if certain banks are still have another shoe to fall? We don't know that for sure. But one thing, going back to my comment about not making market predictions, is that we trust that there's a wisdom in crowds, meaning the market participants that are buying and selling bank stocks are weighing the possibilities of banks continuing to have trouble versus coming out of this. And the fact that we saw bank stocks reprice downward in March tells us that, that information, there is a certain element of risk there, but banks have not evaporated since those the two very first banks that had their problems. So we're not making a prediction, but we think that the Fed promise to backstop deposits is definitely going to stem any real problems for bank customers.
So thank you for that, Mario. And like you pointed out, we are not currently in a recession today, but are we at a greater risk of slipping into recession because of all these things that's happening?
Yeah, that's a great segue. I think we're going to talk about that either on the next slide or a couple that follow. So currently, I mentioned we're not in a recession, and the markers of a recession are displayed on the screen here. And again, I know those of you that are not watching can't see it, but when we think about recessionary signals or markers, we think about things like unemployment, consumer spending, and sentiment, and things like that. So if you look at the signals today, we're not seeing any flashing red. We're still seeing, labor is tight, labor is strong, spending is still, going strong. And a lot of that, the cloud of that silver lining is that during COVID, we know that a lot of consumers built up their savings. And now we're seeing a lot of that savings being spent. So at some point that may wear out and we may start, seeing consumers tighten up a little bit. But as of right now, we're not seeing that recession. As far as signals go, and I'm going to jump a slide here. One of the most important signals that the market gives us about the possibility of recession is called the yield curve, and in particular, the inverted yield curve. So if you are looking at the screen, the top left graph, in particular, the dark blue line, shows us the yields that are currently being paid on Treasury securities, U.S. Treasury bills and bonds and notes at various maturities. Typically, the shape of this line slants from the bottom left to the top right, meaning that you're getting more yield for taking on longer term risk. But right now we have what's called an inverted yield curve. The shorter end of the curve is higher than the longer end of the curve. Short-term rates are higher than longer-term rates. And when we see that, and that's the short end is controlled by the Fed, they are purposefully keeping the short end high to try to, as I said, tamp down demand a little bit. But the market controls the rest of the yield curve through pricing bonds that are existing today. So when the market foresees a recession or downturn, they tend to bid up the prices of longer term bonds, and that pushes their yield down. So again, the wisdom of crowds is telling us that the market foresees a downturn in the economy, if not a recession. And while the inverted yield curve doesn't cause a recession, and it doesn't always give a positive reading or an accurate reading, we have one of the most inverted yield curves that we've seen in recorded history, if not just our investment lifetime. So the signals are there. The fact that the Fed seems to be dead set on controlling inflation tells us that there may be a soft patch coming. Again, we're not here to call a recession, but the folks that really do watch this, that we pay attention to, importantly, are suggesting that if we do see a recession, it may not be a long, deep one. It may not feel great, but they don't expect it to be a massive, depression type environment.
And can I add something there? Maybe I see the glass half full here. You tell me, right? But would you think that if a recession that eventually leads to less wage pressure, right, on businesses and what have you, and some changes in some policies, eventually, could it be something that's actually better for the long term of this environment, of our economy?
Well, I will turn that around and think of a different silver lining. I think one thing that is typically good is the term correction, right? Because of a prolonged period of very low interest rates, we saw a lot of asset prices that were, historically high, stock markets, real estate, things like that. And, when there's easy money, people borrow cheaply and bid up the prices of assets. Yeah. And to the point where some of those asset prices may have been unsustainable. So sometimes when you have this kind of fallout, it does sort of clear the deck a little bit. We may see some other clearing of the deck with companies that are sometimes known as zombie companies that were being kept alive by cheap money and government stimulus and things like that really don't deserve to perpetuate. Given your point, and even my last point, when it comes to the labor market and wages, I think that's going to be considered an industry by industry thing, because in some industries, wages have probably they're probably too low. In certain industries, people are having a hard time even, surviving, let alone thriving. So certain industries probably can see some wage appreciation, and that would benefit workers. But certain others, from an inflationary standpoint, keeping wages in check, as you said, probably isn't a horrible thing broadly.
Yeah. So thank you for that insight. So valuable. So Mario, and you might be addressing this in your a few future slides here, but I do want to point out on something that I heard in the beginning, where the dollar has been high recently, as we all know. Do you think that the dollar will continue to see a dollar strength upward trajectory, or more like, is it going to be going the other direction? What are your thoughts on that?
Yeah, so we do have a slide on the dollar.
Oh, okay. So I'm just gonna let you describe.
Let's table that. Let's get to that when because it'll be appropriate, as I mentioned earlier, when we talk about international stock prices.
Yeah, sounds good.
But one thing I wanted to mention while we're on the topic of the yield curve from an investment standpoint is, theoretically, you could invest not theoretically, in reality, you could buy very short-term instruments like CDs and 3-month T-bills and things like that, and get a higher yield today than you can if you buy longer term bonds like 5-year, 10-year bonds. And a lot of people are questioning whether or not they should just park their investment money in cash versus, taking on investment risk and being invested for the long run. And for emergency reserves, we think this is a nice little bonus, right? You're getting a 4 to 5% return on your emergency funds, but we don't necessarily think you should move money out of your long-term savings, long-term investments like in your IRA or 401k, because that may be a very short-sighted and short-lived opportunity. And the next slide actually talks about that. If you're looking at the screen, I'll just focus on the tallest green bar with the 18.6% on top of it. What this is telling you is that the 12-month return after the Fed stops raising rates has returned 18.6% in the previous rate tightening cycles. So if you're sitting there on cash, right, and you're happily earning 5%, but then you wait until the Fed stops raising rates, or you wait for longer term yields to be higher than short term yields, in other words, the yield curve to return to normal, you could miss out on some substantial gains. So in your IRA, your 401k, your long-term investments, don't let the shiny object of short-term yields totally get you off of your game and what you need to do for the long term.
I think, Mario, I'm going to add there. So, right, the investing in feelings, your personal feelings about the current state of the economy, and what you're hearing on the news and what your friends are doing and what have you. I think that has to speak to that, right? Don't be in a panic to pull it out. So go ahead.
That's right. So, and we can take the same approach when we think about the stock market. And you're right. I mean, we definitely spend a lot of time coaching investors and helping them understand their feelings. There's a whole field called behavioral finance that understands psychology and how it affects our financial decisions. So absolutely, it's a big part of every financial advisor's life and conversations with their clients. And then it's our job to sort of support the notion of not letting emotions get you off your game by looking at historical results and using that as proof that if you just sort of stick to it, stay the course, as the founder of Vanguard and one of my investing heroes, Jack Bogle, said many, many times, you tend to have better outcomes. So similar to not getting out of bonds because you're worried about inverted yield curves and Fed cycles and things like that, what you're looking at here on this page, and I'll throw out some of the numbers in a moment, but you're looking at the 12-month returns of the S&P 500 after the Fed's done tightening rates. So 5 out of the last 6, we've had double-digit positive returns in that environment. The highest one was 36% in 12 months after the Fed stops raising rates. The average over these 6 periods was 18%. So if your feelings and your pessimism is encouraging you to sit this one out, move some investment dollars to the sidelines, you really want to look at past environments. And in very similar environments, if you had made that same decision, you would have missed out on substantial gains.
Right. Don't invest with the headlines. That's what the slide said. And that's absolutely.
Do not invest with the headlines. Absolutely. And as every good, client of a financial advisor knows, the advisor is working with you before the hard times come to make sure that you're not overly exposed to these environments. You have a emergency reserve. Your allocation among stocks and bonds is appropriate for how much risk you can tolerate. And that is so important when we run into, surprising, troubling times. The next point that we are calling out is probably the most technical of the investment talking points that we'll cover today. If you're a student of the investment game, there are basically 2 schools of thought about investments. There are value investors that buy stocks when they're attractively priced relative to some fundamental value of that company that they represent. And the other side is a growth-oriented investor that really doesn't care that much about how much they pay for that stock. They just think that the future is so bright for that security that they're willing to pay almost any price for it. And, you see this often, happened in the tech bubble, the dot-com bubble. Technology stocks find themselves in the growth camp more often than not. But one thing to draw the linkage between interest rates and stock market investing is how value-oriented investments behave and how growth-oriented investments behave given interest rate levels. So without getting into what's on the page, the point is value-oriented investment philosophies tend to perform the same regardless of the level of interest rates. Growth-oriented investments tend to perform worse at higher interest rates. the reason for that is growth companies' profits, the benefit to shareholders are far off into the future, right? And when there's high interest rates, you have to discount that future benefit back by a greater number of years based on the interest rate. So when interest rates are high, those far-flung benefits are worth less today. So pay attention. If you are thinking about how you're invested, pay attention to the ratio of value stocks to growth stocks, and understand that if history is a guide, higher interest rates tend to cause growth to underperform. So some folks, we have a lot of conversations about how much we should invest in US-based companies and how much we should invest in non-US companies. And we've been saying this for a while now. So it's not a guarantee that tomorrow's the day that fortunes change. But if we think about US stock markets versus non-US, after the dot-com bubble, the S&P 500 experienced what came to be known as the lost decade, where you basically didn't make anything by holding just large US stocks. But if you had international in your portfolio, you actually earned a pretty decent rate of return. Since then, about 12 or 13 years since the end of that decade, we've actually seen the reverse. US stocks have done extremely well. International has lagged behind. But going back to that value-oriented investment approach, one determinant of future returns is how much you pay for a stock today. And right now, international stocks are trading much more cheaply, meaning you can buy them on sale, than they have historically, and much more cheaply than you can buy US stocks. So unless you have some belief that US companies are better or in a better position to outperform non-US counterparts forever, right now, the deals are to be had on non-US stocks. And for those of you looking at the page, actually, we don't even need to look at the page, but on the right side, you see that the other benefit of owning non-US stocks is that they tend to pay higher dividends. So even if the valuation story doesn't change, you're being paid more to wait in international stocks than you are here in the US. We're not saying go 100% international, but we're also not saying to abandon that international diversification just because they've underperformed recently. So now we can talk about the dollar, Peachy. So the top graph shows you the value that the US dollar has been versus a basket of world currencies, again, going back to the bursting of the dot-com bubble. So from left to right, you see the dollar's value substantially declined for about 10 years, about 10 years. And then the dollar has climbed since then. This has a direct impact on the performance of non-US holdings, because if we're a dollar-based investor and we're buying non-dollar-based investments, then that means we've essentially transferred our dollars to non-dollars to buy those assets. If the dollar price appreciates in that period of time, then that's not good for our non-dollar denominated investments. But if the dollar declines over that period, that's good, because when we sell that investment, we could buy more dollars back than we could at the beginning of our holding period. So I'm going to probably disappoint you, Peachy, and say I don't have a prediction on the direction where the dollar is going to go, but we do know that values really do work in cycles. Sometimes those cycles are long, but we do see an ebb and flow in the dollar's strength. And with the dollar as high as it's been, or close to as high as it's been in 20 years, it's much more likely that the dollar will continue to come back to earth a little bit. It will depend on a lot of things. It'll depend on our inflation rate, our interest rates. It'll depend on what happens with the war in Ukraine and whether or not there's a problem brewing with Russia, China, and some players in the Middle East. It will partially have to do with the debt ceiling situation in Washington, D.C. So all of those things are really hard to predict. But realistically, if you think about gravity, if nothing else, the dollar really can't strengthen forever. So it's probably a more likelihood that the dollar falls versus rises. Now, I could be wrong. It's not a prediction. It's just the likelihood of that outcome.
Yeah, I understand.
So,
And to your point, Mario, it's really coming back to earth, as you best described it, right? To me, though, it remains to be that the dollar is still a safe haven asset. I think at least that's what I think, because like you said, ebbs and flows. It has been a higher, or maybe the highest in a couple of decades. So it just means there's some sort of correction there, but it doesn't mean that it's the end of it.
no, absolutely. I appreciate you bringing that up, because that's not what the implication is. Just
Yeah.
because the dollar is weaker versus other currencies does not mean that it's weak.
Yes.
We actually, 2 days ago, we just sent a piece out to our advisors who inquired about the dollar possibly losing its reserve status. And an important component of that story is that the dollar is still used for 60% of global transactions.
That's right. Mm-hmm.
And you may say, oh, that sounds low, right? But if you think about the next highest used currency, the euro, is only 20%. You really, how quickly can the financial plumbing change around global trade to get the dollar down in its usage and the euro to triple in its usage to supplant where the dollar is today? Every other currency is single digits.
Yes.
So it's very, very unlikely that the dollar will not be continue to be used as the premier global currency. So that's the extent of my prepared remarks. Peachy, we always leave this conversation with a slide that shows some of the things that advisors and their clients should really focus on, the things that matter, the things that really impact your outcome, and more importantly, the things you can control. Yes, it's good to know investments and know what's going on and know how you're positioned, but things like having long-term goals, keeping to your financial plan, being disciplined, investing broadly, all of these things are really the most important criteria for having a successful long-term plan.
Thank you, Mario. And for those of you that are not seeing this slide here, it does summarize a lot of what Mario just said, where financial planning is a process. It's not the end game. The long-term goals and objectives must be there. You have to maintain a disciplined approach, focus on reaching those goals, not on beating your benchmarks, reduce investment and tax costs where possible, and rebalancing as necessary. And the last piece that you said is the investing broadly and globally, and asset allocation is key. So, all right, I have one more question before I let you go here, Mario. Of all the things that we talked about, I am most curious on your personal thoughts on which global trends you think, and I'm not going to hold you to the fire, just kind of get a feel for, you think that the world economy will be shaped by in the next 10 years. I know, a very generic question, but you can think about it for a minute.
Well, at the risk of stirring up political beliefs and things like that, I think that it would be very difficult for us to ignore the impact that our consumption is having on the climate. Whether it's, most specifically around carbon usage and energy, and moving towards a more sustainable energy infrastructure. From a global perspective, I think that's something that if it's not a prediction, it's something I think we probably should get a handle on. Because I think the implications are too negative, too impactful. And as the father of a 1 and 3-year-old, I hate to keep kicking the can down the lane.
Oh yeah.
And I think the innovation of the next decade, I think, will continue to be in that space.
Awesome points. And I probably would have picked the same thing. Actually, I was having a great conversation yesterday with one of the CEOs of one of the largest insurance companies here in the nation. And I saw him on stage and we were chatting after that. And I said, you're the only person who talked about ESG and the whole environment piece. And, this is the insurance conference. You would think that it has nothing to do with insurance, but it actually does. It does affect a lot of industries. One of that is our insurance. So I know I said it was the last question. So, but I lied. So are there any books that you're reading or you would recommend to our listeners and viewers?
It's hard to really pinpoint anything like that. But what I would say is, read what interests you, but understand the source. Being in the position that we are in, serving more than 20 different advisory practices who in turn serve thousands of investors, what we get put in front of us really runs the gamut. And some of it is very thoughtful and thought-provoking, and other elements of it is pretty dangerous. So I would just, number one, consider the source, read what makes sense to you and what interests you, and then don't hesitate to reach out to a financial professional. If you have an advisor, that's great. Ask the advisor what they think about that material, and just to make sure that it's not self-serving or trying to build a platform for the author. And I know that's not the answer to the question you asked, Peachie, but I did mention I'm a father of a 1 and 3-year-old, so I don't have a book on my nightstand right now. But there's a lot of great information out there. Just don't read any one thing about economics or investments and take it as gospel. That's all I could say.
You hit the nail on the head. Just like investing, you want to invest globally diversified, if I could call it that way. So, Mario, I said in the beginning, this is a treat. Thank you so much. It has been an awesome time listening to you talk about the current state of our economy. If there are financial advisors listening to this and they want to get a hold of you, how do they do that?
Oh, I appreciate that, Peachie. Our email address, mine is mario@eastbayis.com. Our website is eastbayis.com. And we'd appreciate a conversation. We love broadening our network. We appreciate everything that you've done for us, Peachie, in our practice, and would love to be in closer contact with your network.
My pleasure. And I do want to take a few minutes to talk about what East Bay does, because I don't think you talked about that in the beginning. We talked about you, but we didn't talk about what East Bay does for the financial advisors. Who's the financial? Because there's financial advisors, a broad term, very broad term. So take away.
Yeah. So we serve independent advisors who would otherwise want to have a chief investment officer on their staff, but maybe they don't have quite enough work for a full-time staff. They don't want to pay the salary of a chartered financial analyst. So our services are catered to that audience. Our advisors don't want to totally let go of the reins on their investments. They don't want to turn it around, turn it over and have the model portfolios fully managed for them, but they want somebody to help them do the research and make sensible decisions for them and their clients. And then we help them with very specific, unique situations that they may have with specific clients. So in a nutshell, we're a chief investment officer. We're a fractional chief investment officer, outsourced chief investment officer, and our focus is 100% on advisors.
Fantastic. Again, Mario, thank you so much. I appreciate the time that you took for us today.
Thank you again, Peachie.
Bye-bye. Information shared during the show are opinions of the speakers. They are not legal, financial, or tax advice specific to you. Consult your own specialist, attorney, accountant, financial planner, or insurance advisor for your specific situation.